Welcome back to a new video that is very useful for accountants. I challenged Google Gemini to record the journal entries to 4 business transactions. Will the accountant's profession end with this? Let's see.
Transaction 1. The company records monthly accrual of allowance for doubtful accounts. The balance in the account at February 29, 2024 was $100,000. On March 29, 2024, one of your customers, Duke Inc., files for bankruptcy. The customer has $25,000 of outstanding invoices. How do you record the journal entry for the write-off?
To record the write-off of Duke Incorporated's outstanding invoices due to bankruptcy, you will need to make a journal entry that reduces both the accounts receivable and the allowance for doubtful accounts. Here's how you can record the journal entry. Journal entry on March 29, 2024. Debit. Allowance for doubtful accounts, $25,000. Credit. Accounts receivable, Duke Incorporated, $25,000. Explanation. Debit to allowance for doubtful accounts. This reduces the balance in the allowance for doubtful accounts, reflecting that you are recognizing a loss. Credit to accounts receivable. This removes the outstanding invoices from your books, as they are no longer collectible. After this entry, the balance in the allowance for doubtful accounts will be $75,000, $100,000 original balance, $25,000 write-off.
Correct. Transaction 2. The company ordered $300,000 worth of inventory on February 14, 2024. Vendor terms were FOB destination. Inventory was delivered on February 28, 2024. Invoice was issued by the vendor on March 11, 2024. What journal entries need to be recorded in February and March?
Given the information provided, the inventory was ordered with FOB destination terms, meaning that the ownership of the inventory transfers to the buyer only when it arrives at the buyer's location. Here's how to record the journal entries in February and March. #####February 2024. No journal entry is needed in February because the inventory has not yet been delivered, and thus the company does not take ownership of the inventory. ####March 2024. Once the inventory is delivered on February 28, 2024, and the invoice is issued on March 11, 2024, you will record the following journal entries. 1. When inventory is received, February 28, 2024. Debit. Inventory, $300,000. Credit. Accounts payable, $300,000. This entry recognizes the inventory received and establishes a liability for the amount owed to the vendor. 2. When invoice is issued, March 11, 2024. Since the invoice is for the same amount and relates to an already recorded liability, no additional entry is necessary at this point regarding the invoice itself. The accounts payable account already reflects the amount owed. Summary of entries. February 28, 2024. Debit inventory, $300,000. Credit accounts payable, $300,000. March 11, 2024. No additional entry required. The total effect on your financial statements will show an increase in inventory and accounts payable by $300,000 as of February 28, 2024.
The first part of the answer is correct. I agree with you on the debit side, but payable for 300,000. Now see, with this one I may disagree with this one because the credit here in this case should not be accounts payable because the invoice has not been issued yet. There is a liability, but it should be accrued liability. The accounts payable itself will be recorded in March once you receive the actual invoice and you have an invoice number and a due date. Transaction 3. The company sells website hosting services. In April 2024, the company signs up a new customer for a 3-year contract for a total of $2 million. Expected revenue. Part of the agreement, your company as the new supplier will pay customer $500,000 to satisfy the previous provider early exit fee. How do you record the journal entry for the early exit fee?
In this scenario, the company is incurring an expense to pay the customer's early exit fee of $500,000 as part of the contract agreement. This payment can be recorded as an expense in the period it is incurred. Here's how to record the journal entry for the early exit fee. Journal entry for early exit fee, April 2024. 1. When the early exit fee is paid. Debit, customer acquisition expense, or a similar expense account, $500,000. Credit, cash, or accounts payable, if not paid immediately, $500,000. Explanation. Debit to customer acquisition expense. This reflects the cost incurred to acquire the new customer and satisfies the previous provider's exit fee. Credit to cash. This reflects the outflow of cash for the payment. If the payment is not made immediately, you would credit accounts payable instead, indicating that you owe this amount. Summary of entry. Date: April 2024. Debit customer acquisition expense $500,000. Credit cash, or accounts payable, $500,000. This entry recognizes the expense related to acquiring the customer and reduces your cash balance or increases your liabilities, depending on how you handle the payment.
Correct. Transaction. 4. The company sells software as a service. In April 2024, the company signs up a new customer for a 3-year contract. The agreement is worth $9 million of expected revenue, $3 million each year. The company paid a $200,000 commission to its sales employee in connection in April 2024. Record the journal entry for the commission transaction.
To record the commission transaction for the sales employee in April 2024, you would make the following journal entry. Journal entry for commission paid, April 2024. 1. When the commission is paid. Debit, sales commission expense $200,000. Credit, cash, or accounts payable, if not paid immediately, $200,000. Explanation. Debit to sales commission expense. This reflects the cost incurred for the commission paid to the sales employee, which is an expense related to acquiring the new customer. Credit to cash. This reflects the outflow of cash for the commission payment. If the payment is not made immediately, you would credit accounts payable instead, indicating that you owe this amount. Summary of entry. Date: April 2024. Debit sales commission expense $200,000. Credit cash, or accounts payable, $200,000. This entry recognizes the expense associated with the commission and reduces your cash balance or increases your liabilities, depending on how you handle the payment.
This is incorrect. Because the debit should not be an expense, this is a cost that is incremental that is associated with a new contract acquisition and under revenue recognition rules. The expenses associated with the acquisition of new contract if the cost is incremental, meaning the cost is only incurred as a result of signing the contract. Meaning if we do not sign the contract, we don't incur the cost, then it's capitalized and amortized over the life of the customer or the agreement.
The channel is for those interested in professional certificates, accounting and auditing. Follow us to receive all new updates. Thank you for watching.